Let's talk markets and stocks. Kari Firestone, Aureus Asset Management co-founder, joins us now. Kari, great to have you with us. It's been quite a couple of 2 weeks here. But interestingly, we've got a lot of the old leadership back firmly in place, back above those August 8th levels, and talking about the semiconductor index, NVIDIA, Apple, Meta, Amazon, the KRE. So banks are back up there. And the yen carry trade is mostly unwound here, although there is a move back to it this, in the past couple of days. Have we de-risked? Where are we now? What's your assessment of this journey?
Yeah. Hi, Melissa. I would say that we had a scare. It seemed to be a panic. That was resolved because it seemed to be mostly technical and yen related and the carry trade. And so now we're about 2% back from that all-time high. That was July 21. And it's been driven mostly by the big cap names because their businesses are on track. Of course, we're waiting for NVIDIA, which reports on the 28th. But also, we've seen this big jump with consumer discretionary, which very recently was down for the year. I mean, the market is up 16%. Consumer discretionary is now up under 4%. All that has happened in the last couple of days. So that's a shift. We're seeing some money that's been moving into other parts of the market. The broadening of the market has been talked about endlessly now all year, and it hasn't really happened, but it seems to be starting to occur. This is a catalyst, and we had Warren Buffett buying Ulta, the Walmart news, July retail sales up 1% versus a much lower consensus, and Brian Niccol moving to Starbucks from Chipotle. All those ignited this rally.
What do you make of Walmart at this point? They had great earnings. Their second half guide stood still. So overall, it looks like the full year got raised, but actually it was just outperformance from the first half that was added onto their guidance. But it is the number one stock in terms of performance on the S&P 500 retail to date. And its forward PE is like 31, so above the market multiple. Is it worth it?
Well, it's not a cheap stock here. I think that the market is really looking at the glass half full scenario where the Fed is going to lower interest rates and we do not fall into a recession. We've been in a soft landing. There's been a lot of talk about whether this softness that we've heard through earnings season, where earnings beat for the quarter, but revenues were light. A lot of the benefits came from cutting costs and margin improvement, but from every part of the economy, whether it was software, healthcare, financials, even the tech names said that revenues were not as well. They just didn't come through as much as expected. So Walmart is a stock here that we've seen consumers were spending. They saw it all across demographic sectors. And while people traded down, they still came to the stores. They bought food. I mean, food is more of the business now than consumables or the typical retail products. But customers come to Walmart, and if they're feeling stretched, they're more likely to buy private label. They trade down, and that is exactly what Walmart is offering them. 30 multiple, that's fairly expensive. The market sells for about 19 times next year's earnings, but earnings expectations are strong there and across the S&P. The estimates are for 15% growth next year, which is a big ask. And so we have to see consumers spending money, consumers 70% of GDP. And so there, I would say, kind of the North Star. If Walmart is leading, we'll see what happens in the next couple of weeks. Names like Target and across the board, we have to see retail also holding up.
Are you placing retail bets, Kari? And I'm wondering because, Walmart was talking specifically about the majority of their gains in market share came from the customers with household incomes $100,000 and more. And they're coming in, they're buying groceries, but they're also buying discretionary. And actually the sale of discretionary goods like like pillows and T-shirts and things like that was actually flat for the quarter versus declines in previous quarters. So is that a good read-through for Target or a bad one because they're actually just gaining the share?
It's unclear, I think, to the market whether it's good or bad. Target, of course, has underperformed Walmart. Target has been a difficult stock because they've mentioned this, that the consumers have not been back in force. What we know is that for 2 years, people spent their money at home, online, and then renovating their houses. Then for 2 years, they spent money on travel, vacations, experiences, concerts, restaurants. So now we may be entering a period where the spending is more at the mall or at retail because you can go to the mall many, many times for the price of a Taylor Swift concert. And that may be what's happening. We're shifting the whole sector think, the consumer spend think, toward traditional retail, and we'll see if that follows through with the other participants and companies in the field. It's a good thing that the Fed is lowering rates because credit card debt goes down and there's been an increase in delinquencies. But one name, you had Walmart, good, Tapestry, 2% growth in revenue, and the stock was up big yesterday. And we have to see if the revenues really come through over the next month or so. We'll hear more, and then there's back to school.